Are you tired of struggling to pay off your debt? I'm talking about credit cards, student loans, auto loans, or any kind of debt. Maybe you're confused by all the debt payoff strategies like the debt snowball or the debt avalanche and can't figure out which one is better. Well, in this video, I'm not only going to explain which is faster for repayment, but I'm also going to explain 2 often overlooked tips to help you repay your debt in just under 2 months faster in most cases with the same amount of money. Welcome back to another video by Black Swan Financial. And if you're new here and interested in learning about investing, trading, real estate, or personal finances in general, please consider hitting that subscribe button if you find video content helpful. And now that's out of the way, let's get to it. So when it comes to debt repayment strategies, if you hop onto Google, you're likely to come across 3 main strategies first. Highest balance first, debt snowball, debt avalanche. But just to be thorough, we're going to add 3 more strategies to that list. Balance transfers, equally dispersed payments across all debts, and cash flow priority. Now, before we jump in and talk about all these debt repayment strategies, the very first step, if you're serious about repaying your debt, is to calculate the weighted average interest rate across all of your debt. That way we can use just one interest rate across all of your debt to evaluate all the different alternatives. And really, what we're trying to do is to figure out what is the best use of your money given the multiple options that you have available. For example, should you invest in your retirement account or focus on debt repayment? Should you consolidate your credit cards via balance transfer or not? Should you refinance your federal and private student loans or not? So just for a quick example, imagine you have the following debts for a total of $61,869.22. To calculate the weighted average interest rate, we would simply weight the interest rates on each debt by its dollar amount in proportion to the total balance. Once we do this, we see that the average interest rate across all the debt is 8.73%, which is above the historical rate of return of 7% for the stock market. Which means if historical patterns hold true, you're going to get more value by paying off your debt than investing in the stock market. Say that you have $100,000 of debt and $100,000 of cash that is invested in the stock market. Using these weighted averages, the cash invested in the stock market would return $7,000 in the first year. However, the debt would accrue interest of $8,730. Essentially, all of your gains will be wiped out by interest accrued. As a general rule of thumb, you want to go with the alternative that has the highest rate. But even if the rate of return on the stock market is higher than the interest rates across all of your debt, that doesn't mean that you should totally ignore your debt. Because left unchecked, those minimum payments can balloon, especially if we're talking about credit card debt. So to wrap up on this point, if you're debating on whether you should focus on repaying your debt or contributing to your 401k, in this scenario, you want to contribute to your 401k only up to the company match and then put the rest towards debt repayment. Step number 2 of debt repayment is to figure out how much money, if any, you can put on top of your minimum payments towards debt repayment. Now, I'm going to assume that you got all this figured out, but if you need a little bit more help, take a look at my previous video on budgeting for financial success. And now we're ready to move on to looking at each of the debt repayment strategies. Highest balance first. Unless you're trying to prioritize boosting your credit score by reducing your credit limit utilization rather than saving money on interest, you're going to want to avoid this strategy because it typically isn't the fastest. Going back to our previous example, focusing on paying off the $24,000 student loan not only won't save you the most amount in interest, but it'll most likely give you the least of a boost on your credit score compared to paying off your credit cards. Moving on to the debt snowball. Now, the next strategy is one made famous by celebrity coach Dave Ramsey. Basically, you focus on paying off your smallest balances first and build up momentum as you knock out one balance after the other. A lot of people like this method because it makes them feel like they're making progress as they knock out the smaller balances. The debt snowball is often compared to the debt avalanche, which is paying the highest interest rate balances first. Now, a lot of people swear by the debt snowball, but let's dig into the numbers and see which one of these strategies is actually better. So to compare these 2 popular strategies for yourself, you can utilize the Vertex Debt Repayment Calculator. See the link down below in the description to download a free copy. Using this free tool, you're able to enter your debts and see how the selected repayment strategy will impact the amount of time it takes to repay and the total amount of interest paid over the life of the loan. In general, prioritizing the loan with the highest interest rate will save you the most amount of money. More money than the debt snowball method, more money than the highest balance first method, more money than equal payments across all loans method, and allow you to redirect funds to other financial goals faster. However, there are some situations where you want to consider other debt repayment strategies. For example, if you just graduated from school and you're in the 6-month grace period but worried about how you make your monthly payments once the grace period ends, you may want to focus on paying so that you maximize your monthly cash flow. Similarly, now that the government has frozen all interest on federal student loans, you may want to use this period to focus on maximizing your monthly cash flow once this interest-free period ends. To utilize this strategy, you want to have a near-term deadline in mind. For example, the end of your 6-month post-graduation grace period on your student loans, or the end of the zero interest on federal student loans in December. Next, you'll want to total up the amount of extra payments above your minimum payments you can make between now and your deadline. And from there, you simply take a look at which loans you can pay off between now and your deadline, with a priority on the one with the largest monthly minimum payment. So using our debt example from earlier, once your deadline has passed, you should have increased your monthly cash flow by $114, which should make keeping up with things just a little bit easier. Now, to be clear, this is a use it once type of strategy. So once you've used it, you should then shift your focus over to using the highest interest rate strategy first. Balance transfers or refinance. Another strategy would be to transfer balances from one credit card to another at a lower interest rate for a promotional period of time, which can sometimes even be as low as 0%. Now, this can take two forms. Credit card B sends the money to pay off credit card company A, or credit card B can send the money directly to your bank account and you allocate the money as you see fit. When looking at this repayment strategy, the key things you want to keep in mind are opening a new line of credit will negatively impact your credit score. Credit card balances have a greater negative impact on credit scores than loans. Promotional interest rate, the duration of time for the promotional rate, the interest rate after the promotion ends, the fee for the balance transfer, and the required monthly payment may be higher, especially if refinancing non-credit card balances, which means if you're thinking about transferring your loan balances over to your credit card, the monthly required payment on the credit card is probably going to be higher than the monthly required payment on the loans, even though the interest rate may be lower. Again, when deciding whether this is the right option for you, you want to compare the weighted average interest rate across all of your debt and compare that to the promotional interest rate on the balance transfer or the refinancing offer that you have after accounting for any processing fees. Similarly, if you're considering refinancing your student loans, you want to consider the following. Make no mistake, by opting to refinance your federal student loans, you're refinancing to private loans. Once you do that, there's no way to get them back to federal loans. Additionally, private loans have less hardship protection and repayment options such as the income-based plan than federal loans. Also, be sure to check the fine print as private loans can have either variable or fixed interest rates. And lastly, consolidating federal loans does not impact the interest rate, but rather repackages your loans into one loan at the weighted average rate. Now, when it comes to student loans, you may be able to pay your loans off just about 2 months faster by setting up auto pay and by making your payments as soon as possible rather than waiting on the due date. For example, if you have $50,000 in student loans at a weighted average interest rate of 6.8, you could save $389.07 by setting up auto pay over the life of the loan and $766.67 by paying at the start of the month rather than on the due date, for a total savings of $1,155.74, which is just shy of 2 months of payments shaved off of your loan altogether. Remember, with just about any debt, interest is calculated daily, so the earlier you pay prior to the due date, the more interest you'll save. So there you have it. The fastest way to pay off debt depends on your unique situation, but in general, paying the highest interest rate first will get you debt-free the fastest. Before you go, if you haven't already, please go ahead and hit that like button and subscribe. That way you can be sure you don't miss out on any of the great video content in our upcoming videos. And lastly, we want to hear from you. Tell us your greatest triumphs and struggles when it comes to debt repayment and drop us a comment below. We'll see you next time.